What's going on, traders? Welcome to Celestin Capital. Thank you guys for tuning into this brand new video. Now, in this video, I'm going to continue the MLBM series that we've been talking about that I've introduced for you guys. If you guys don't know, MLBM is a brand new concept, a brand new way of looking at Wyckoff. That's simply all it is. If you guys are tired of having to label every single part of Wyckoff, like the preliminary supply, the UTAD, the STB, then this is one of the videos for you guys. If you guys want to see the entire the general summary of the MLBM series, go ahead and check out one of the videos that I posted earlier. I forgot what the title is, but it gives you guys an in-depth look into the MLBM series that I've created. So again, this is for those traders that are tired of looking at Wyckoff and having to label every single part of it. For me personally, I like to simplify my trading because trading is hard as it is already. I'm just trying to make it as simple as I can for myself so I don't have to stress. So everything becomes second nature rather than me having to think about every single thing. All right. So again, this is just a strategy that I've cultivated, another perspective of looking at Wyckoff. Instead of having to label every single part, I've simplified it for you guys. Now, this is going to be the liquidation episode of the MLBM series. The last episode I posted was manipulation. Now we're going to go into the liquidation, and the next video is going to be the break of structure or breakout. I prefer break of structure. The last video is going to be mitigation. So again, this video is all about liquidation. Let's talk about liquidity a little bit. I also posted a video about liquidity if you guys want to check that out. It went really in depth into liquidity and how the banks make their money. So that's a nice video if you guys want to check it out. You can go ahead and scroll down my channel, go into the list of videos and scroll down and you'll find it somewhere. So again, liquidity. Let's talk about liquidity a little bit. So let's say we have some kind of support and resistance, right? Say we have some kind of support and resistance. Usually before the market makes its big move, it's going to throw some kind of fake out. So as you see here, we have both support and resistance here. Usually before the market makes its big move, it's usually going to throw some kind of fake out. So, those traders that are buying at support are going to place their entries here, place their positions here. And again, as I told you guys in the previous video about liquidity, millions of orders. Don't think it's just one order. Don't think you're the only person buying from here. It's millions of traders, millions of traders. So there's lots of entries here. So this is just to give you guys a perspective as to what the banks are looking at, right? They're looking at the orders. They're looking at where people are buying and selling from. So if the banks know that people are buying from this area, I'm going to keep it with one entry just to simplify things. Again, millions of traders here, millions of people taking the same positions. The banks know that people are buying from here. What are they going to do? And their stops are over here somewhere. What are they going to do? They're going to drive the market down. They are going to drive the market down to stop out those buyers that are buying from this area. Same case with selling. If the market makers see some kind of resistance up here and people are selling from there, some kind of area where people are more likely to sell from, what are they going to do? They're going to drive price up. And usually what happens is, this may have happened to a lot of you because I know this happened to me a lot before when I was brand new to trading. Price would go against me for a little bit and then continue in my direction. Right after price would stop me out, price would continue in the direction that I anticipated it. Now, this right here is a run on liquidity. This is what we call liquidity. Now, let me explain something else for you guys. So there's also traders that use sell stops and buy stops. Now, what that is basically, let's say they don't want price to leave them. Let's say they're expecting sells from this area just in case they get stopped out of this buy. They also have sell positions that are going to get tagged in. So what a sell stop is basically, let's say price is somewhere up here and you're expecting price to come down here, right? What you're going to do is you're going to place some kind of order. So when price passes this line, it's automatically going to tag you in and you're expecting it again to continue down. So price is automatically going to tag you in and go in profit, right? So that's what people are expecting with sell stops. With buy stops, just the other way around. Let's say you're expecting to buy, you have your entry up here. Once the market passes this price, you get tagged into the order. And again, you're expecting price to buy, so You're expecting price to do something like this to continue up. Now, what also happens is that people place sell stops and buy stops up here. So they would place their sell stop, their buy stops up here. They would place their sell stops down here. So if price were to cross this area, what's going to happen? They get activated. Their orders get activated, and they're expecting price to continue down. Now, this is also liquidity because again, they're expecting price to continue down. Their stops are up here. What price tends to do, this is what we call a run on liquidity. What price tends to do is go down below that support area. Again, fake them out into thinking that price is going to sell. You know, they get stopped out of their buys, and then if they have sell stops open, then they get the sell stops get activated, and they're expecting price to continue down. And what happens is price wicks down, again, wicks down, and then continues the other way, stopping them out, right? So this is for sell stops. They're expecting price to sell. Once price gets below some kind of support area, they're expecting price to sell. So they've got sell stops open. So once price goes below that area, their sell stops get activated. And then what happens is that price activates their sell stops and then takes them out of the market. That's what we call a run on liquidity because price is faking them out into thinking that it's going down, but it's really not. What happens with buy stops is that price fakes them thinking that the resistance is broken. They get tagged into their orders, into their buy orders, their buy stop. The buy stop gets activated, and what happens is price drags them out of the market. Price liquidates them out of the market. A lot of times you'll see a wick get thrown, a wick, and then you'll see that candle close somewhere down here below the area of support or resistance, or in this case, below the area of resistance. So that's what we call a run on liquidity or liquidity in general. So there are certain different types of liquidity. I just explained them both to you. We've got the support liquidity and we've got the sell stop and buy stops. We've got the support resistance liquidity and then we've got the sell and buy stops. Now let's take a look at a live market example that I have marked up for you guys. So this is one of the live markets that I have. So as you see here, you got a lot of people that think this is some kind of area of resistance, right? So they're like, oh, well, this is what we're going to do. We are going to sell here, and this wick looks nice, so we're going to put our stop loss right above that wick. Now what happens is price, as you see, price comes, price runs liquidity with this wick right here. This wick makes price run liquidity. A lot of the times you'll see just a wick, not a break of structure, not price close above the resistance line. So you'll see a wick get thrown up, which activates the buy stops in this case. And then what happens? Price continues in the other direction. So that's one example of a buy stop. So a lot of people have their buy stops and it gets activated and they get liquidated out of the market because again, we are looking at wicks, not candle closes, right? So the wicks tell us what price is going to do. The wicks give us a lot of nice price action that we can look at to determine what price may want to do. Again, we're not 100% certain of the market. In that case, we'd be 100% traded, right? We'd never lose a trade. It's not the case. And here's another quick example right here. We have this high that gets put into place. And what happens? Price looks like it's breaking structure to the downside. So we would have some early sellers get in the market. Some early sellers get in markets, either some early sellers or some people who just want to buy the market once price gets above this line. Because again, it looks like price is bullish. You see this huge bullish candle, like, oh, I can't miss the trade. So I'm going to put a sell stop. Just in case I'm going to sell this market, and just in case price wants to go up, I'm going to put a buy stop. Excuse me, is what I'm going to say. I'm going to put a buy stop. So what happens? Buy stop gets activated. They get taken out of the market because their stop losses were up here. Buy stop gets activated and they get taken out of the market. Now here's a buy side example that I have marked up for you guys. A lot of times you'll see this again, run on liquidities, run on liquidities. What happens? The market throws some kind of support, some area of support. Then what happens? You see this area of support right here. The support gets taken out. People think the market's going to sell. Sell stops get activated. What happens? Price breaks to the upside and the structure holds. So you see price continues to the upside. Just this wick alone can tell you a lot about what price wants to do. This run on liquidity. This is what we call liquidity, all right? So people with their sell stops get activated, and then what happens? They get liquidated out of the market. Now, if price were to close below this this low right here, then that would be a different story. That's something else. That's what we consider a break of structure, and that's going to be in the next video. But because price actually wicked down here, we can see that price is telling us a different story rather than a break of structure. And again, you can see the manipulation here. So again, instead of having to label every part of Wyckoff, the selling climax, automatic rally, all of that stuff, it's simplified. It's simplified for you guys. We have a run on liquidity, we have a break of structure up, and then we see this demand zone hold very nicely. What happens? Price continues to the upside. So that is what we call a run on liquidity. That's what we call liquidity, guys. That's the simplified version of Wyckoff. Now, there's still more parts to the series, and I don't want to make them all in one video, so I'm breaking them down. This was the liquidity video. In the next video, I'm going to talk about break of structure. So I'll see you guys in the next one. Hopefully that made sense for you guys. If it made sense or if it did not make sense, let me know down in the comments below. And if you want to stay tuned for more content, be sure to subscribe. If you like the video, be sure to hit the like button. And if there's anything else you want to know, type it down in the comment section below. I'm open to suggestions. I'm open to make more videos for you guys, whether it helps you learn, so that it helps you learn and grow as traders. So I'll see you guys in the next one. Again, this was a liquidity video. Next, you're going to see break of structure. So I'll see you guys in the next one. Peace out.